Should you dollar cost average when you're investing, or should you invest a lump sum? So if you want to know about what investment strategy to maximize your earnings the most, right? The big ones you're going to read about is do dollar cost averaging or lump sum investment. Now let's explore those numbers and uncover kind of what's the best pathway to the best financial growth. Hi, I'm Laurent Meunier from Safe Pacific Financial, and welcome to our channel, and welcome back if you've been here before. Today we're talking about what investment strategy is going to get you the most money. Is it dollar cost average or is it lump sum? Obviously I can't see the future, but based on data that's provided by the Royal Bank, we can look at the last 30 years and see what has had a better track record and what's worked better. So now before we get into which one is better, let's obviously figure out what do these things mean. So dollar cost averaging. What does it mean? It means simply and you'll also see this online as DCA. So it's re-entering the market with a smaller sum regularly. This could be once or twice a month, once a week, or even every day. But essentially it means that you invest whatever that number is. It could be $20, $50, $100, $1,000 as often as you can. And you do it on a consistent basis on the same schedule so that you will eventually get as close to the average price of that investment while spending a little bit less over time. So some of the advantages are, as the price of whatever it is you're buying, the stock or the ETF or the mutual fund or whatever, as that goes up, your $100 is going to buy a little less of it. And then as the price of that thing goes down, your $100 is going to buy a little more of it, right? So over time, you're going to get the average. So on the other side, lump sum. The lump sum investment is, one lump sum. So you put that in whenever you put that in. So you might put in $10,000 once a year, maybe at tax time, you got a refund or something like that. And then you let it sit and you grow until the next year when you put in another $10,000. Which one works better? And what does the data actually say? So the data that we have from RBC goes back 30 years with companies that invest the lump sum against the DCA strategy. So over that period of 3 months and 12 months, the lump sum strategy comes out on top in every single time period. And this is because generally markets rise over time. So the dollar cost average investor often bought at average higher prices. And then the things that you want to keep in mind when you're looking at this is that the results are based on one-time lump sum payments or investments of $10,000 made at the beginning of each time period. And the dollar cost average is the $10,000 spread out evenly each month over that same time period, right? So you either put the 10 grand in now or you put it in over the time period. Obviously, data is very helpful when you're making investment decisions, but most of us are not a computer, right? We're not a calculator. So obviously your emotions also play a heavy role in decisions. So especially when you're investing. Now, imagine that the market starts to drop. How do you feel about investing a large lump sum of cash as the market is going down? Do you worry that it'll keep going down? And then so you don't invest now. And then by not investing now, you stay on the sidelines and you don't put the money in. And maybe you don't put the money in for a very long time. Now we've got another chart that you can see here. So this is using data from the global financial crisis, so 2008, which compares the experience of a dollar cost average investor versus the lump sum investor. And we took 2 6-month periods here, one where the markets were going down and one where the markets were going up. So now keep in mind for this chart that there's some assumptions, right? So each investor here has $50,000 to invest. The dollar cost average investor put that $50,000 in over 6 months in equal monthly installments. And then the lump sum investor put the whole 50 grand in on the first day of that 6-month period. So things to keep in mind. So when markets are going down, the dollar cost average approach, it protects the investor's holding compared to the lump sum investor. What's not shown in this chart is that the dollar cost average investor reached break even 3 months after the market low in June of 2009. Contrast that to the lump sum investor didn't get his initial portfolio value back until December 2010. When markets are going up, the lump sum investor had way better performance in that 6 months after the market low. Nevertheless, committing to the lump sum investment during this period would have been highly unsettling, right? Especially during that economic turmoil, those conditions that were happening at that time. It was kind of crazy. Despite trailing the lump sum strategy in terms of immediate results, the dollar cost average investor still achieved pretty good returns through the more cautious and gradual approach, right? Some final notes here. So as we discussed, The data demonstrates that lump sum investing typically will benefit investors. But if re-entering or entering the market for the first time is challenging to you, dollar cost averaging can assist into making that first, step. It feels safer. You're putting in a smaller amount of over time and you're doing it more consistently. The dollar cost averaging also offers a more consistent investment journey. These are really factors that you want to think about when you want to stick to your long-term financial strategy. So there's another shorter video this week comparing the two ways to invest. And whether you do it this way or that way, don't feel bad. The worst thing you can do is do nothing. Here we're talking about technical data that RBC's pulled saying that this one technically is better than this one. If you do either one of them, you will be fine. If you don't do either one of them because you're not deciding and you're just not making the move, that's where you're going to lose. That's where you don't get ahead. Yes, technically putting the lump sum in and getting the money into the market right away usually will win. But if you don't have, if you're not able to do that and you're like, no, I'm scared. I don't know what I'm doing. I don't want to just put it all in. What if it goes up? What if it goes down? I don't know. The dollar cost averaging strategy works really well because then you just say, listen, I'm putting in this much per month or week or whatever your time period is. I will get the average and I'm happy with the average. The average is better than zero. Do one of them, pick one. Now, if you gained any sort of value from this video, or if this is something that you still kind of want to know about, leave a comment. We watch these comments and we'll reply. Also, if starting your investment journey or you want to just transfer investments to somebody who cares and who can do a good job for you, we help people with this all the time. You can get in contact with us through our website. It's safepacific.com. You can send us a message through there. That'll come to me and somebody on the team will reply to you within 24 hours. We have a really good investment platform that we use. We can help you whether you want to do lump sum or whether you want a dollar cost average over a period of time. We're happy to help you. And then if this video helped you, can you help me? It's really easy. All you do is push that little thumbs up button that says like, or you can push the subscribe button. And then can you help somebody else? Is there somebody in your life that you know trying to invest right now and doesn't really know what they're doing, or that maybe does know what they're doing but could use a little bit of help? Share this with them. By doing all this, you tell the algorithm, you tell those robots that you love us and that you want YouTube and LinkedIn and Instagram and Facebook and all of these social platforms to share videos like this with more people that are like you. That's it for me today. I will see you next time.